welcome to Money, Money, Money. I'm Surabhi Upadhyay. An all-time high. Every time we reach this milestone in the stock market, it leads to several very diversified emotions. There are some of us who feel absolutely elated. There are some of us who feel a little despondent because of the feeling of having been left out, having missed the rally. And then there are many of us who are just simply confused, not knowing what lies ahead, what to do. So we thought that this is a good time to go back to the drawing board. We looked at a lot of questions. You've been flooding us with queries on our digital platforms, on our timelines about what to really do next. It's a great time to go back, look at your portfolio, go back to the basic rules of asset allocation, of what your goals are, medium term, long term, short term, and see if there's something that needs to be done. So to help us over the next 1 hour, the first half hour is going to be on television. The next half hour is going to be on our digital platforms. We have a panel of experts. Kalpen Parekh, President at DSP Investment Managers, who represents the mutual fund sector. Feroz Aziz, Deputy CEO at Anand Rathi Private Wealth Management, as well as Ashish Shanker, Deputy MD at Motilal Oswal Wealth Management. Gentlemen, thank you very much for taking out the time, and thank you for taking out 1 hour, not the usual half an hour. And I'll tell you why we requested for 1 hour this time around. I'll start off with a query from Jay Patel. It really embodies the ethos of the confusion and the questions which are out there. Let's hear out what Jay had to ask the panel.
Since market are touching all-time highs, so do you think we should start switching to debt funds or government schemes since real rates are very negative, or we should invest in equity funds?
Okay, so I think Jay represents so many of us. I mean, there could be my voice, I mean, our friends, our family's voice echoing exactly that question. So, gentlemen, I'm going to open it out with you. Ashish, let's get your thoughts on board first. Yes, this is an all-time high. There's a lot of excitement around, a lot of positive sentiment flowing through. Is there a need to go and do something to the portfolio?
Hi, Surabhi. Always a pleasure to be on your show. So let me answer it in two parts, right? First, the boring answer that, ultimately the portfolio is all about allocating money between different asset classes, right? Which is debt, equity, gold is also become an important asset class, cash. And as long as, you're following that asset allocation model, you don't need to make any knee-jerk changes, which is if, let's say, equity has run its course and it's overweight from what you had decided earlier, then it's a good time to take some profits. But if you're not fully invested, then just stick with your allocation, right? So that's something which all advisors will tell you. But let me give you, my sense on markets, and I think that's where this question is coming from. See, now, having been in the market for close to 2.5 decades, I have seen many cycles. Now we're coming out of a very, very deep fall, and the way we have emerged and the market has risen, this definitely looks like a bull market, Surabhi. Let's not make any bone about it. It looks like a bull market. Now, what typically happens in a bull market is markets always run ahead and fundamentals tend to follow or catch up. Okay, so this time around again, if you see the last quarter's profits, they are at a record high for the quarter, for the Nifty. Profits went up 17% year on year in a pandemic year. Okay, that's something. Now, that's not, all. If you look at the estimates for the full year and the year after that, it is significantly higher. So we are in a market where, although Nifty is rising, but at the same time, fundamentals are keeping pace, right? We've always complained that fundamentals have not kept pace with the market. The market is running on liquidity.
Sure.
And let me tell you this, every bull market runs on liquidity. I don't know a single bull market which is not run on liquidity.
Sure.
This other thing to, ponder over is, we...
Okay. I think okay, we are having a slight trouble with Ashish's feed. We'll just go back and fix it as well. But, Feroz, I think also why people are asking this and why I don't want the question to be dismissed is because, yes, we all know that we should, buy and invest for the long term. But let's face it, I mean, simply buying and forgetting hasn't always been the best strategy, especially in the last couple of years, if you just go by mutual fund returns. Feroz?
Yes, Surabhi. Of course, I think if you look at it from the last 3-year, 4-year pocket perspective, you will realize that buying and holding might not have been the best strategy. But market behaves differently in different pockets. Firstly, it's very important to understand what's the context in which this correction happened and what's the behavior of the market after a correction this steep. Always bull runs begin after a sharp fall. I think over the last 6-7 months, we at Anand Rathi have been propagating the fact and convincing people that that sharp fall could result in a huge rally. So if you look at the last 6 falls, sharp ones, the average return 3 years after that have been about 150% from the lows, and the worst being 70% and the highest being 300%. So every time you've seen these last 6-7 falls in India over the last 20 years, you've seen very, very sharp, great bull runs subsequently. And if that's an indication of 150% average return 3 years from then, I think we've just got 50-55% of it. So I think you still have a 100% return possibility if you go by the averages of the fall. So it's important to understand this context. Otherwise, higher levels give you some degree of intimidation to stay invested in equity. Every day, equities are going to make new highs, just like a fixed deposit makes a new high every day. So that's point one. Point two, we have globally $16 trillion of debt money in negative interest kind of instruments. That money is going to definitely find its way, and India is going to be a beneficiary for sure. And I think the third point, one last point, Surabhi, is the fact that Indian interest rates are low and Indians are not used to it. So you will see a large flight of capital from debt to equity. So I would like to believe that next 4 or 5 years are going to be different than the previous 3.
Okay, well, optimistic statements, and I take your points on board, gentlemen. But again, I'm going to, be batting for the investors and for the uncertainty they feel. And it's important to then pull up returns, and we'll pull up those graphics. Now, hear this out. If you talk about absolute returns, basically, if you look at the last 3 years or 5 years, from date to date, then those returns are going to look slightly lower, which is why the mutual fund industry, experts these days tell us to look at rolling returns. We'll ask our experts to explain why and whether that's the right way to go. But this question is to the mutual fund boss. So, Kalpen, now this is the hardest question to you when you're wearing that DSP t-shirt, which is very prominently displayed. There is an element of mistrust that's growing in. The reason why people are now sitting at the edge of their chairs, wondering whether to sell, whether to redeem or not, is they don't know whether just staying invested, whether they'll lose this beautiful gain that they've seen in the last 9-10 months.
Okay, so Surabhi, first of all, thanks for posing the most difficult question to the least wisest of men on this panel. I'll try to do justice to this in the most honest way. And I'm not, oversimplifying this, but I'm giving a very real life perspective. In my own family, 3 generations, father, myself, and my son. To my son, and all 3 of us are invested in different degrees in the market with different life cycles and life stages. And I would, only urge viewers to also not expect oversimplicity from markets. So markets are at a high, no doubt, they are at an all-time high. But remember one thing, our age also is at an all-time high every day. When we study in school and college, we also are crossing an all-time high every year. Do we react in our life to all-time highs every day? The answer is no. Feroz made an important statement that fixed deposits also, have an all-time high every day. We do nothing. We get 4% returns after tax for generations and generations. But we are happy with that. When it comes to equity markets or equity funds, the expectations end up being very different. And my submission here is, if you have any, need for money in the next 1 to 3 years, use this brilliant opportunity to book profits, to rebalance, to take some money off the table and, fulfill that, near-term goal, which is likely to be there. If you have medium-term goals, which are 3 to 5 years away, then use it to rebalance between equity and debt. So we run an equity fund called Dynamic Asset Allocation Fund, and looking at principles of valuation, over long history, Today, from 40%, we are rebalancing it down to 30. So today morning, we got a signal that at current valuations on price to earning and price to book, it merits some rebalancing from equity to debt, but to the extent of only 10% of the portfolio. So for investors who have a medium-term goal, use this to rebalance from equity into debt or a slightly lower risk profile. And for investors who have a longer term goal where you don't need money in the next 3 years, 4 years, 5 years, but you are here for the next 7 to 10 years, honestly, rebalancing it today and waiting that, okay, I will re-enter at a lower value is futile. None of us have been able to do it, however much we wanted. And the data for that, each investor should look back that in the month of March, were we able to rebalance when markets were at a low? The answer is most often no. So in my view, your solution should be in line with what your goals are. Near-term goal, book profits. Medium-term goal, rebalance. Long-term goal, do nothing. The second question was, what about returns? The last 3 to 5 years have been, fairly, very boring or average returns in line with fixed income only. No doubt, last 10 years, overall corporate earnings also have not grown. And here I would, also want to highlight that as a community, we need to do a lot of work to explain to investors that equity investing does not mean linear returns every year or every 3 years. There are lost decades in countries like US, in countries like Japan, for 4 decades, no returns were made. So we all need to acknowledge that returns will have cycles. You take Indian equity markets between 2003 to 7, markets went up 15 times. Small caps went up 15 times in 4 years. But 2007 to 2008 to 2014, in 6 years, markets gave 0 returns. So all I'm trying to highlight is, if you are expecting linear returns in equity as an asset class, then it is not the right asset class. Okay. Then maybe fixed income is a better asset class. Be okay with lesser returns, but you'll get predictable returns. Okay, equity will be unpredictable. Even from here on, be ready. Markets can give 10-15% correction. None of us here on the panel will be able to tell you when will those corrections happen, because they never come invited, or they never knock our doors and say they're coming. All I'm saying is, right now, no doubt markets have run up a lot. Use this opportunity to rebalance if you need money. And if you don't need money, do nothing is my only advice. Okay. That's a very, put very clearly, I would say. But I would request the panel to keep replies short, because trust me, there are lots of questions. We haven't even begun. And we are, I think, 15 minutes into the show. Let's quickly move to the next question. This is coming from Shailendra Kumar. And he's saying, I've missed the rally. What do I do now? Let's hear out the query if we can.
My query is regarding, I want to do a lump sum investment in mutual funds. So actually I missed the rally in stock market. So I just need some advice for a 3 to 4 year perspective on a mid cap or a small cap funds. So if you please advise me for that period. Okay, so let's take this up with Ashish. Now, Ashish, one can imagine the sentiment. First of all, is this the time to do a lump sum right now? And then I also want you to comment on a category that Kalpen just referred to. Some of these funds which follow algorithms and which follow formulae and start booking profit. The point is that right now we're not trusting our fund manager to book profit, which is why a lot of us want to redeem. So do these categories like dynamic asset allocation, do they make sense to you if someone like Shailendra wants to now invest for the next 4 to 5 years?
Right. So Surbhi, just because he's missed the rally is no reason not to invest at this point in time. I mean, imagine somebody who's been a fixed income investor for the last 20 years. He's missed so many rallies in his life. But if you've decided to invest in equities now, we have this proprietary valuation indicator. Now, the valuation indicator is definitely suggesting that on a trailing basis, markets are a bit expensive. Now, whenever markets are in the expensive zone, we tell people that you should stagger your money into equity funds rather than putting in lump sum. So that's the answer to your first question, that this guy should stagger his investments into equity. Now, gauging by his question, the reason he stayed out of equity markets is probably because he was scared, right? Normally, a seasoned equity investor would stay invested through the vagaries of the market. So for such an investor, a dynamic asset allocation fund is not a bad idea at all. I always tell people that, there is a certain hierarchy to taking risks, right? You start with debt funds if you're a bank deposit investor, and then you want to move towards equity. You go to a dynamic asset allocation fund, and then you're okay with the volatility of a dynamic asset allocation fund, then you can move to a pure equity fund or a mid or small cap fund. So it's very, very important to link the experience of the investor, the outlook of the investor, and his temperament to what kind of funds he's choosing. I think he also asked a question on mid and small cap funds at this point in time. See, our house view is that mid and small cap stocks are definitely far cheaper than their larger cap counterparts, right? From a historic perspective, because they're still below, they're about 10 to 20% lower than their all-time highs, and we still believe that there is a lot of steam left.
Sure.
But given the question, the way the question has been framed, I would definitely say that mid and small cap funds may not be for this particular investor because it comes with its share of volatility.
Yeah.
So tomorrow, if you were to put money in the mid and small cap fund, even with a 4-year view, if the fund falls 20% and he's going to redeem the money out, then definitely it doesn't serve the purpose.
Okay.
So hope I've managed to address all the queries.
Yes. That takes care of Jay's question on mid and small caps as well. We do need to take a break, but on the other side, we get down to specific math. The big question, are you better off taking some money off the table and paying the tax liability, short-term or long-term capital gains as it may? Should you do that or just keep the money there and let it compound? Where do you earn a better return? We'll take up an example in just a bit after the break. Welcome back. You're with us on Money, and this week you're asking the simple yet confusing question: stay invested or book profits at all-time highs? Well, let's do the math, and we got Feroz to give us an example and illustrate this. So Feroz, why don't you tell us the numbers? The basic thing is, if I'm sitting on a gain, is it better off to pay that capital gains tax and pocket it, or is it better to remain invested?
Surabhi, what happens is when you exit, of course, there are exit costs and taxation. If it's in the short term, you have exit costs. So let's take an example. If someone has invested about 100 rupees and has got a gain of 50 rupees, so that sums it up to 150. If a person took away the investment or the gain amount, 50 lakhs, by selling all his units, for example, so then he has a 50 rupee gain, on which there could be short-term capital gain or long-term capital gain. If there is a short-term capital gain, a person ends up paying 7.5 rupees out of the 50 rupees, and then the cess and the other surcharges which are applicable. So you are looking at almost 7.5, 8 rupees out of your 50 rupee gain vanishing in taxation. And if that's long-term, then you end up paying 5 rupees as your tax. So what you're left with is not 150, you're left with 142.5 in case of short-term investment, you're left with 145 after paying the taxes. So point being made here is, now once you go out of the market, and if let's assume you're lucky enough to get a 10% fall in the market and then you re-enter, right? So if you re-entered your 142.5 or 145 as the case may be, you will end up having a total differential of a loss of 4 rupees in spite of getting a 10% fall in the market. So point is, the cost of actually getting out and getting in is 4% for a short-term investor, and the cost of a person getting out and getting in the long-term category is upwards of 1%. So there is transaction cost, especially the tax component becomes quite taxing in this case.
Okay, all right. So the math is telling us that you ought to stay invested. But remember, Feroz has assumed 15% return in this particular example. So maybe that's a separate debate with him on the 15%. What if the market doesn't go up that much, right? But that's perhaps a later day. Right now, we have more questions to answer, gentlemen. Vivek has a query. Now, Vivek is asking that value funds have not seen too much of action in the market since 2016. How does an investor choose a value fund? Kalpain, I know you guys at DSP are doing a value fund right now. Now the criticism always has been that they tend to underperform. Now, if from where we are, the market keeps rising, and if you're really in a bull phase, then investors might feel a little upset. But how do you explain value, and is there enough a universe of stocks? Because India is always believed to be a growth market.
See, this label of value and growth in isolation is a very flawed concept. I want every investor to recognize that value and growth are inseparable. True value, you cannot give value to a company which does not have inherent growth in it. So, these are false labels that value means only cheap companies or weak companies which have not done well, number one. So, growth is an integral part when we value a company. And when we build our portfolio, clearly these are companies which have grown in the last 10, 15 years as well, just that they are not the most expensive in the market. So we are, eliminating the outlier most expensive companies and playing in the middle. Number two, precisely because value has not done well in the last 5 years is the reason why we are launching the fund today. See, there are two approaches. One, we can launch a fund when the category has done very well and come at the peak of the cycle. And when we raise money at the peak of the cycle and the cycle turns down, the investor experience is far more poorer. It happened with technology funds. It happened with infra funds in 2008. It happened with small and mid-cap funds in 2017 and 18, right? After that. So in launching funds at a market high is easy for us to raise money because it is comforting to look at past returns. But then the future experience is bad. At DSP, and I must say that, a lot of advisors today in the industry recognize this cyclicality and are hence always happy to offer ideas at the bottom of a cycle. So whenever a category is underperforming, is a good time to launch it. Now, will it turn in 1 year? I don't know. But what we are clear is that in times like this, it allows us to build a portfolio because a lot of companies which have not run up are available in, meaningful quantities. Okay. And lastly, we also have an option in our fund that if we don't get the stocks of our choice at the right price, up to 1/3 of the portfolio, 35%, we can keep it in cash. And we can stay patiently out of it and wait for the right time to build the portfolio. Okay. Having said that, if markets continue its one-way rise, this portfolio will underperform because it's a defensive, conservative fund. So an investor who is more conservative should choose this fund. An investor who is more aggressive should not choose this.
So I just have about a minute left now on the show. So before we move to the rest of the queries on the digital platforms, Feroz and Ashish, very quickly now, in 30 seconds each, make the perfect bouquet for us. So Ashish, if I could come to you first, there's so many different kinds of fund categories. There are US funds, there are multi-asset funds, there are value, dynamic asset allocation. So creating the right bouquet can be a daunting task. What would it be for you, Ashish?
So I think I would prefer the multi-cap category and possibly some allocation to small and mid-cap funds. So if I were to just take, 4 fund names, I would say a Kotak Equity Ops and maybe a Mirai would be my choice of multi-asset funds. And Mirai Asset is actually a large cap fund. And in the small and mid-cap, I would say an Axis and Invesco. And then, of course, there are other funds also available on our platform. There is this DSP Quant Fund, which picks companies based on an algorithm. So these are some of the funds I would recommend, Surabhi. But the underlying mood, as I said, is to have more exposure in the broader market than in the top 50, 60 companies, precisely because they have performed extremely well. Okay, Feroz. And I do believe we are at the cusp of a bull market. And I think the broader markets will do very well over the next 3 to 5 years. Okay, Feroz, your perfect looking mutual fund basket. And I'm wondering if you're adding any new categories, all these, US equity funds, a lot of fancy stuff out there, so many different categories on offer.
Surabhi, to my mind, I think asset allocation, which is very critical, I would still say 65% being in equity for 60 to the extent of 65% is critical for the next 5 years. To my mind, then coming to the product category on the mutual fund quickly, I think what we believe is focused equity funds are underrated. They definitely deserve more attention. To my mind, because they're high conviction ideas. That's one. Otherwise, I think conventional large and mid cap and multi cap schemes chosen perfectly can help you create alphas over the next few years. Coming back to the exotic ones, which come into flavor every time the past performance is very good. So I would ask you to stay away from them, be it sector funds, be it theme based funds, or even global equity. I think we are too late for global equity rally. India would be better poised. So that's the recommendation. If I have to get more specific in terms of schemes, and now that we have Kalpe, DSP mid-cap is our favorite scheme on the mid-cap category. Then SBI focused equity in the focused category, and in the large cap category, Mira Asset Large Cap, as Ashish mentioned as well. Multi-cap, I would say Kotak Standard Multi-Cap, the largest one of the largest fund in that category. These four funds have a large potential over the next 3-4 years.
Okay, so there you go, viewers. You've got some recommendations as well. Now, this conversation has only gotten warmed up. On television, we're going to take your leave. But if you are still interested more in mutual funds and asset allocation and talking about a whole host of other things, and of course getting your queries answered, then we're still live on our digital platform. So keep it with us. Facebook, Twitter, you'll find this broadcast continue on those platforms, and we'll be back in just a moment.